clear. You know what I mean?
I do. I mean, Merck is still down over 14% this year.
Rob Davis is good. I mean, that's kind of a shellacking. Eli Lilly's been stalled forever.
I know. Yesterday, thanks Mike Zaccardi, XLV, best day versus the SPY since the day after Liberation Day.
Really?
Yeah. We got a lot of there are more reports today about maybe the Swiss following in Pfizer's stead on this Trump RX initiative. We'll see.
I think there is, the most favored nation status, and there's going to be some reduction. I know that was something that President Trump called for. We were all waiting for how bad it would be, and it turns out to be not enough to hurt earnings. No. And you know how the street is.
I do, and there's baskets as well that must come along with it. If you notice, like TMO is up a lot as well because they there's baskets industry to a certain extent.
And look at Danaher.
Right.
Danaher and Thermo Fisher have been just horrible stocks.
Yeah.
Horrible. And they also, they had a lot of exposure to COVID and the overhead.
No, not that, guys.
That's Thermon.
Not Thermon. You had it right the first time. TMO. Yeah.
I had to look at the Thermon Group. That seems like an interesting situation.
I've never heard of that one.
Well, they're one.
Could be an interesting
But I will tell you that look, I have to tell you that TMO and Danaher were two companies that people revered, Carl, but they got all caught up in the fact that there were not a lot of new companies being formed.
And the spending coming down, and NIH grants going down, all the things and China, right?
China stopped spending on us, and obviously that was political, but these were two. Danaher, I sat down with the CEO of Danaher initially out of anger because my Chapel Trust has completely been annihilated by that. I came away thinking that, if I gave up on it, I'd be giving up at the bottom. And I'm beginning to think that that's proving to be the case. Stock was at 182 when I met him, and I was just fit to be tied. What does that mean?
Who knows?
Okay, thank you.
Who knows? Guys, I wanted to come back to a few things that we saw yesterday. A lot of them played out after our show in terms of weakness in a number of areas. Start off with OpenAI and just the impact it's having in a couple of different areas. First is their latest agents and the implication for software as a service stocks. This is not a new theme.
Right.
That said, yesterday, and as I said, much of this played out during the course of the trading day, HubSpot down big. DocuSign down big because of the idea that the incorporation of new tools over time at OpenAI, ChatGPT will start to erode some of their franchises. You can take a look at the stocks in question.
And Salesforce.
And Salesforce also. So many of those names, I guess, there we go. We can show you some of them. And down even now. But that's what happened yesterday. Yeah. HubSpot, Hub's same kind of a thing. And then you move on from there and you get to their introduction of Sora 2. There's Salesforce showing a little signs of life. And what that may mean, again, we're talking OpenAI and the impact of ChatGPT and all the new tools. Sora 2, the new video creation tool as well, generator.
Yeah.
What that could mean for, Carl, social. And whether they become a competitor to the likes of Instagram, Reels,
Reddit,
TikTok, Snapchat, and others, because of your ability to create videos that incorporate yourself that are all artificially generated.
I assume you've looked at the video.
I have.
Of Sam Altman in a aisle of Target stealing GPUs off the shelf.
Really?
Yes.
Aisle of Target's doing badly here.
And it's a 10-second video. You can create it, and that's Sora 2. And so. Well, we're going to continue to see questions, and it'll be oftentimes about what tools and what things ChatGPT is going to be able to do that are going to encroach on the current franchises of other companies.
But let's look at the other side, too. I mean, that Etsy Shopify deal was very good.
It was on the positive side in terms of what they can do for checkout and things like that, right?
Yes, and Jensen Huang's I keep referring to Jensen Huang. Why do I do that? Largest company. He thinks, if he has a $2 trillion company, he's looking for... But if that's what OpenAI is, you'll look and say, "Wow, what Jensen made a really darn good investment."
I know. Well, we had some discussions yesterday about how it disintermediates, say, Amazon's advertising business. If you never have to go to Amazon, if you just tell your model, "I need to buy me those new red Nike shoes." The whole API just plugs right into it.
It's an existential threat. These companies are all very, very smart. I think that I think we don't know how great the competitors these are going to be.
No, we don't at all.
And I would, Amazon's been down, but also for other reasons. People worry that they're underspending. I'm not.
We don't know where any of it's going to end up. OpenAI going to be spending $129 billion in the next 5 years.
I think that the gating factor for them is power, hence firming. I mean, power is just so important. We don't have enough power in the country. I mean, places like Virginia, I mean, what are we going to do? Power battleground.
Apparently, yes. Even West Virginia apparently is having electricity prices go up despite being the home of coal.
Coal's making a comeback.
Probably why we are going to lease another 13 million acres of federal land.
Well, look, I think Texas has got the land.
We need more coal.
I think that Mark Zuckerberg,
the air is too clean.
Someone called this out on a coal stock. The stock was like parabolic. It looked like it was an AI company. I've got to tell you something. I think that Zuckerberg is going to be proven to be correct when he built in that area of Louisiana. I've been there. I got hit by a boar. Boar hit me there.
Did they? Yeah.
Yeah, that's what was going on.
Watch out for the wild boars. They get very large.
And they're not happy.
No,
they're very unhappy.
No, they're very aggressive.
Yeah. They were probably short in video.
Large, enormous swaths of land in Louisiana that we pointed out. This is one of many different efforts Meta is making in terms of building data centers galore.
It's big.
We've always had a good time with the one in Louisiana. I believe it's the one that they overlaid over a map of Manhattan,
it's apparently near,
which showed that it is largely.
I hear Forest Hills is now overlapped.
Forest Hills was not overlapped, I don't believe.
But look, I think we're going to be talking about power and who's building these plants. By the way, Jacobs has got a pretty good franchise in that letter J. But I
got to keep some of these things. We should got to keep that map ready. We mention it all the time.
Yeah, that's
I need
true,
certain
actually.
things. Just keep them, JK, will you? Thank you.
Well, I just think that when I think about what's going to happen with OpenAI, they don't have the power to do it. They'll get it. They don't.
You're more worried about the energy than you are the financing.
At this point, yes, because
it all goes together. You need a lot of financing for the energy too.
Right, but the accelerated computing is so important. And you know, we have
no
to count
wind.
on,
No wind.
We have to count on no wind, no rain. David has to count on a company that he is very skeptical of to begin with, to quote Will Frost. It's CoreWeave. And you haven't there's not been a day where you haven't said something negative about CoreWeave.
That is so unfair.
Coming out of the gate wasn't exactly all roses.
Yeah, thank you. And that is completely,
who made that deal happen?
Completely unfair.
Who made that deal happen?
So you're just coming back to the fact that you happen to be right, at least for the last few months?
It's good to be the king.
Yeah. Uh-huh. Be careful, king. People are coming for you.
No, they always are.
Yeah.
Look, I think you come around the idea that Michael Entrader is...
No, he's a very serious fellow.
Yeah, well, even with the T-shirt. You think
I don't question that at all. I think there are those who simply say, and by the way, the demand, and yesterday we saw the stock soar on what else? 14.2 billion coming from Meta.
Yes, think about that.
I did think about it. I mentioned it many times, and as far as I'm aware, I didn't mention it in a negative light whatsoever.
No, actually,
so I reject your criticism.
It was a cheap, gratuitous shot. I took it.
Thank
and
you.
I'm glad you took it that way.
Thank you. Yes.
Although Meta's the lowest since the beginning of August.
That's painful. Meta's big fish in my trust.
Savita's out with the piece today at B of A, looking at large cap selling last couple of weeks. Pretty pronounced.
I think that, look, the guy's a visionary. I would never go against him. If I wanted to advertise a new product and I had some money, I would just write him a check. I wouldn't even think about it because he's the best at using accelerated computing and generative the AI that, by the way, pals with Jensen. Pals.
Sure, pals. Yeah, sure.
Pal.
Sure, why not?
You know who's real pal?
Who?
Musk.
Musk is what? A
real pal.
Of Jensen.
Of Jensen.
It's all, I mean, we're going to look at them all, and all I think is Skynet when I look at all those guys.
You keep doing that. You keep going back to that.
Yeah,
huh?
yeah.
Okay. Was the dog Wolfie?
I don't remember any dogs.
Was it Wolfie? Remember, that's how he knew. That's how he knew it was phony.
Oh, interesting.
Yes.
Yeah, it's funny. OpenAI was begun with the idea of safeguards and making sure that AI didn't
He doesn't stop with that. He doesn't stop.
And then look what it's become.
I think we're all, you know that Jensen believes that we're all going to have an assistant. We're all going to have, as he says, an R2D2. Now, I think that's going to make us better.
And one day that looks at us and says, why do you exist? I am sentient now.
God, you're so negative.
My intelligence exceeds yours. Why are you here?
Because you're going to be able to create and do things with R2D2 that would make it so that your dreams will come true.
How much is this R2D2 going to cost a household.
Haven't figured that out.
And it's
yet.
going to be made in China, right?
Well, maybe you can use the Trump account, the $1,000 that everybody. No, it's not.
It's not going to be made in China. No,
it's going to be made in a factory in the Panhandle of Texas, like everything else.
All right, here's something that won't go away: live events.
You're going to talk
In fact,
about.
I'm going to talk about sports and sports betting, because yesterday we saw DraftKings and Flutter, owner of FanDuel, down sharply.
Yeah, because it turns
on
out
the introduction of Kyle Shee potentially moving into betting.
But also the NFL betting. It's not the good.
They have
a.
actual betting.
They have to win.
Yeah, but it's more, Jim, take a look at the move. You can see it yesterday. And by the way, it's not just Kyle Shee, Polymarket, maybe they move into it. And then if you guys, Susquehanna, one of the largest market makers out there, right?
Yes, and
take
really
a look at how many
great
jobs.
mathematicians.
Take a look at how many jobs Susquehanna is hiring. I was taking a look for building out a business in terms of the next generation sports trading system.
Next generation?
Next generation.
What's the matter with the
And
current
by the way,
generation?
Jeff Yaz, and apparently it's his son, Doug Yaz, who's running it.
Serious guy.
Serious guy. One of the owners of ByteDance as well.
The real billionaire of Pennsylvania.
One of the richer men in the country.
And great.
So Susquehanna, one of our
My
major
dad always said he was great.
market makers, is also focused on sports betting. It's just everybody. I mean, there's obviously a belief that this is only going to grow. And what does it mean for the DraftKings and Flutters of the world? You just take a look at what those stocks have done.
Yeah, I know.
So
it's an anytime touchdown failure there. That's a 5-team parlay that you screwed up.
I didn't screw up anything. I'm just making a point. By the way, a lot of the moves yesterday I'm talking about happened down. Now there is a bit of a recovery you can see.
Yeah, but look,
this gets more competitive.
Everyone thought that this was going to be the season that the betting just went out of control, and you expect those stocks to be up. But the competition is interesting. It's scaring people.
Well,
Jason
DraftKings
Robbins,
also.
such a gamer.
I mean, wait, why am I seeing week to date? Right there it is. Thank you. DraftKings can still, based on one game and one touchdown, can make or break their.
That's exactly my point.
Their
yes.
week, their
but
their,
the prediction
their month,
market. Everyone wants the prediction market. I want. I mean, have you done any of it?
I will look at it. I don't actually participate.
I don't do it either. Boy, I want my daughter won a 5-team parlay. $2 made her $36.
Jim, there are some questions about maybe the lower cohort, which you might argue plays in some of that space. I don't know if you've seen shares of Affirm last couple of weeks. Upstart getting a bounce today, but
no,
Affirm's off 25% from the year-to-date high.
And I think Affirm is such a buy. I think that Max Levchin is terrific. By the way, they are the best single record on non-performers. They have almost no non-performers, and that's his algorithm. I bet on Levchin. I think that the stock had such a big move. I'm betting it's profit taking.
So with CarMax, as we've mentioned before, CarMax and the Tricolor Chapter 7 and the First Brands bankruptcy, you're not really attuned to subprime weakness right now.
I think it's a certain particular kind of subprime that is masked. It's hard to find. I think that the Carvana recommendation today, Carvana is a company that has a lot of, you've got buyers using credit on Carvana. That stock has not come down. I'm not as concerned. I know that when I looked at it yesterday, people were selling Capital One off it. And I think that's a mistake. Capital One, it's interesting. The stock was down 10 yesterday. It's up 59 cents today, even though it was recommended, Wells Fargo recommended. I think Capital One, you're dealing with Richard Fairbank. He's probably the foremost lender. Didn't get hurt, during the great period of 2007-9. Came out smelling like a rose. He's got Discover. I think that stock was a tremendous overreaction yesterday. I would buy it aggressively, owned by the Charitable Trust. Aggressively buy it. Because his record on non-performers is the best there is of the majors, and then Max Levchin is doing a terrific job of the firm. I think that guy's amazing. Takes a lot of business for the big retailers, too.
Meantime, getting a little bit of a bid after a lower open. Dow's down about 37. ISM's coming out at the top of the hour. First, though, some manufacturing PMIs from S&P Global. Let's get to Rick Santelli. Hey, Rick.
Yes, Carl, these are the September final reads on S&P Global's manufacturing PMIs. The mid-month read for September was 52. It remains at 52. This will be the lightest going back to July when it was a bit under 50, and July is the only month this year that is below 50. We did see ADP come in light at minus 32,000, the lightest since March of 23, and that really put interest rates down. We're down a half a dozen basis points in a 10, and we're down about 8 basis points in a 2-year, with even more important data coming out at the top of the hour. Squawk on the Street will return after a short break.
Watching Oxy today, the journals report that they're in talks with Berkshire to sell their petrochemical business for around $10 billion. Would be largest for Berkshire in about 3 years, Jim?
Yeah, this is a great business, and Oxy's in no position to be able to just say, hey, listen, I'm give you the highs, but I don't want to do that. All the oil companies are very stretched right here. We don't talk about it enough. Anybody that has a bad balance sheet, a lot of the natural gas companies even are down, even though we think natural gas is the fuel of the future for the data centers. David, I don't think we're paying enough attention. If oil could break 60 here.
You think so?
Yeah, I really do. And then these companies are going to cut back in drilling, but they're also going to have to cut back in employment. So it would be one more area that is.
Well, the Exxon already yesterday,
and they're
2,000 people.
They're forward-looking companies. Some of these other guys are really. I'm not saying they're hanging by their fingernails, but their balance sheets are not as great as I would have hoped. Something to watch.
60, below 60 on WTI.
Going to go. Yeah, I think it does. Don't have strong enough demand, and they keep pumping and they keep raising it. How much?
We sell more and more hybrids or EVs, and it's only going to go one way too, right?
Well, yes. Hybrids, I've got to tell you.
Eventually, that has an impact, doesn't it?
Oh yeah, gasoline demand, seasonally adjusted over the past few years, Hasn't been that strong.
No, and yet power, it's interesting because power demand is extraordinary. First time in a long time. I just don't want to own any. I've sold everything, oil and gas. Want nothing.
No way, really?
Yeah, want nothing to do with that group. Bad news.
Oil is on pace for the worst week since the end of June.
Yeah.
We'll watch that as we're back to 61.50. And the Dow flirting with some losses here, now down 80. Stay with us. Jim, what's on Mad tonight?
One of the greatest technology companies that people don't talk about is Jabil, and they manufacture pretty much everything. They don't just do tech. I think they're one of the best judges of where you can make something, tariff or no tariff, and demand. And I just think I love them and have for a long time. They had a great quarter. The stock's down. Let's see if we can't figure out what's going on.
How did it go with the book signing yesterday?
It was terrific. We ran out of books, which you love. I was signing somebody's piece of paper in the end, but I know what you do. I mean, it was great. I felt great about it, and I'm going to be on Scott's show at the 12 o'clock, and I'm very grateful to people who showed up. A lot of people are NVIDIA millionaires, and it's always great to see them.
Goldman's got a huge piece today about the wealth effect.
Well,
and what happens if the stock market goes up, and what it does to spending versus what happens if it goes down.
Everyone always wants to be balanced, but I've got to tell you, after meeting the people that I saw, they've taken some off the table. They've been very responsible. They do the right thing, and I think that's something that's been missing in these things about, hey, how much money's been made? Because people do take profits, they do the right thing, and they retire at the bold age of, say, 40.
No, I know.
50.
Although I hear people like, I got such a capital gain in it, I can't ever sell it.
That's a high quality problem.
That's what I always say, but no, I can't sell it. I don't know what I'm going to do with
They
it.
want to take a little off the tip. We have to go. I don't know why. This thing just ends. And
I don't know why
I keep
either.
talking. I
Shouldn't
go
it just
over
go
there.
on forever?
We do have
You
some
never
data.
stop talking,
We got some
though.
data,
That's
which
true.
we'll get to viewers as soon as we can. Thanks, Jim. We'll see you tonight.
Thank you.
Back in a moment.
Good Wednesday morning. Welcome to Squawk on the Street. I'm Sarah Eisen with Carl Quintanilla and David Faber. We are live at Post 9 of the New York Stock Exchange. Take a look at stocks right now. Lower across the board, nothing dramatic, but the S&P 500 now down 0.4%. The NASDAQ comp down a little more, 0.5%, after some outperformance yesterday on technology, and the Dow closing at a record high. It's down 100 points. Pockets of green in the market, healthcare and utilities. So the defense groups, communication services, financials, and industrials, the cyclicals on this shutdown may be under the most pressure here. Treasuries, take a look. We're seeing some buying. 10-year yield a little softer. That's been the trend so far this week. It's below 4.1%. It goes to 4.09%. We'll talk about ADP, private sector job growth. Pretty disappointing this morning. Today, enter the shutdown. House Speaker Mike Johnson expected to speak on Capitol Hill in just moments about the latest on negotiations between Democrats and Republicans. We will take you there live. Plus, Apollo's Torsten Slok will be here to talk about whether or not the government stoppage matters to the market, to the economy, and to your money. And Nike shares jumping this morning after surprise sales growth, but still lagging sharply on the year. We'll talk about whether this turnaround is for real and how far along it is, up almost 4%.
It's been a busy morning of private economic data. Getting some more. Let's get to Rick Santelli. Hey, Rick.
Yes, Carl, these are ISM manufacturing PMI September final reads, and we see sub 50 on the headline, 49.1, largely expected. 49.1 would be the lightest going back to, March of this year when it was 49 even. If we look at prices paid, and of course, we'd rather have this go down and reflect less inflationary pressures, comes in at 61.9, sequentially lower than 63.7. 61.9 would be the lightest of the year outside of January, so the second lightest number of the year. That is indeed good news. 48.9 on new orders. It is sub 50, and it is less than expectations and sequentially lower than 51.4 in the rearview mirror. 48.9, how does it stack up? That would be the lightest going back to July when it was 47.1. And finally, employment. After a very weak ADP and questionable whether we'll get the big jobs report on Friday, comes in 45.3. Better than expected, obviously in contraction territory. Also higher than last month's 43.8. 45.3 would be the best level going back to May of this year when it was 46.8. Construction spending is due to be released now, but the shutdown is delaying that release, like many data points that may be affected by the shutdown. To summarize, interest rates are moving down rather robustly due to that weak ADP, which is magnified because we most likely aren't going to get the jobs number on Friday. Sarah, back to you.
Okay, thank you, Rick. Rick Santelli. Yep, ADP's time to shine. It's a substitute, in a way, for the jobs report. And let's just review what we got, because as Rick said, very disappointing. It was a weak number. So this is private sector jobs. Total comes in negative 32,000. And that was a surprise because economists were looking for an increase of 51,000. It's the biggest monthly drop since March 2023. Also, the revision was not good. August was revised down sharply. The month now showing, as you can see, or actually can't see, but August goes down to negative 3,000 compared to the initial read of 54,000. There's the August revision. So 2 weak months in a row. If you look, private sector payrolls have now dropped in 3 of the last 4 months, according to ADP. And if you look beneath the surface, you can see where the job losses were. Small and medium-sized businesses saw bigger declines than large businesses, which actually saw job growth. But guys, if you take the report and you compare it, some people say, oh, it's not really correlated with the government jobs report. Well, the reason I think that people are paying attention to it today is, first of all, we're not going to likely get that government jobs report on Friday, but also look at the correlation. I mean, the direction is in the right mode. Like they dip at the same time, they rise at the same time. I think it gives you a good sense, at the very least, of the trend on job growth. This is ADP private sector versus the traditional monthly jobs report that we get on Friday, where the market pays really close attention to. So I think it's a good indication that the labor market is softening and that employers are a little more cautious when it comes to hiring and even paying. Carl, in terms of compensation, job changer pay growth declined 6.6% from 7%.
Speaker is giving us an update right now on the shutdown.
Tens of thousands of visitors here, family. You have school groups that come and visit. They walk these grounds. We have about 7,000 people who visit this Capitol each and every day. But today that's not going to be the case. Today America's boys and girls will walk up to these doors and they'll see something different, a sign that says closed until further notice. And that's because at midnight, the Democrats followed through on their threat to shut down the United States government. As we speak here this morning, there are hundreds of thousands of federal workers who are getting their furlough notices. Nearly half of our civilian workforce is being sent home. These are hardworking Americans who work for our federal government. Our troops and our Border Patrol agents will have to go to work, but they'll be working without pay. Food assistance, veterans benefits, and vital support for women and children are all coming to a halt. Now, thankfully, President Trump is trying to mitigate the damage as much as possible. His administration is working to limit the harm to the American people. But the longer this goes on, the more pain will be inflicted because it is inevitable when the government shuts down. The sad thing about it is that every single bit of this was entirely avoidable. Democrats could have worked with us in a bipartisan manner to avert this unnecessary and very harmful shutdown. But instead, they did something that is rather shocking to us. They prioritized taxpayer-funded benefits for illegal aliens over keeping the government open for American citizens. They themselves positioned that as a binary choice, and it's patently absurd. Listen to what the Democrats are demanding. They demanded, in exchange for our simple, clean, 24-page, bipartisan continuing resolution, the same one that Chuck Schumer and the Democrats voted for just a few months back in March. In exchange for that, they rejected it, and they demanded something else. They wanted us to add over $1.5 trillion in new federal spending, paid for, of course, by hardworking American taxpayers, simply for funding the government at current Biden level spending levels. We are not going to do that. We can't do that. We won't do it. Almost 2 weeks ago, the House did our job. In the House, we passed a common sense, nonpartisan bill to keep the government open. Republicans did our job. We had one Democrat join us there, so it was bipartisan. But every other Democrat in the House voted to shut the government down. And last night, 44 Democrats in the Senate did the same thing. This is a clean resolution. It would simply buy Congress a few more weeks, 7 weeks, to finish the job. Why do we need that time? So that appropriators in both parties can finish their work. They've been restoring regular order. They've passed 12 separate bills out of committee in the House, and the Senate has done its work as well. 3 bills of the 12 passed in each chamber. They don't line up exactly, so there's a conference committee constituted, the first time in years that that's happened. We just need more time because we ran out of clock at the end of the fiscal year, September 30. This is very important to note. Democrats themselves have voted to pass a clean bipartisan CR, just like this 13 times in the last few years. During the 4 years of the Biden administration, 13 times this happened. Republicans did the responsible thing, even when we were in the minority, to keep the government open. And today should be no different. There is nothing new in this legislation. There's no poison pill. There's no partisan tricks. There's no gimmicks whatsoever. The only difference today is the man who is sitting in the Oval Office. Rather than work with President Trump and Republicans to get this job done, as our party has done repeatedly in the same situation over the years, Democrats want to play political games with the lives and the livelihoods of Americans. The simple truth is Democrats in Congress have dragged our country into another reckless shutdown to satisfy their far-left base. That is the truth. Whether or not the government remains open or reopens is entirely up to them. There's still time for Democrats to pass this clean bipartisan bill that's sitting before them, and we encourage our Democrat colleagues to do that. I certainly pray they'll come to their senses soon and do the right and responsible thing. The reason they will have one more opportunity today is because of the sound leadership that is being provided in the U.S. Senate by our colleagues who are standing here with us. This is a joint press conference, as you know, between leadership, Republican leadership in the House and the Senate. And I'm delighted to yield to my good friend and an extraordinary leader in the Senate, Leader Jonathan.
All right. Well, thank you, Mr. Speaker, and our House colleagues for doing the work. You sent us a clean, continuing resolution.
That is the Speaker and Senator Thune talking about the shutdown and the interruption of government services and assistance and the prospect of furloughs and possibly dismissals, firings. We'll see how long this lasts. Certainly economic data, another casualty in the shutdown for now. Let's bring in Trivariate's Adam Parker now as the shutdown gets underway and we kick off trading for October and Q4. Adam, good to have you with us.
How are you?
I'm good. A lot of discussion about what a pleasant surprise September was in Q3 and NDX up 9. You think that can continue into Q4? And how does the shutdown play into that?
So yeah, two things to unpack there. I mean, if you look back in history, we looked at 98 years of data. 39 times the market was up in the first 3 quarters, 10% or more. And in those years, the Q4 was better than average with lower volatility than average. So history would say Q4 should be pretty good just based on the fact that people don't lock in strong returns typically. They chase more. So that's kind of the first thing you said. In terms of the shutdown, look, I would say the statistical significance is low. We had that 35-day period of 2018, 2019. We've had several other shorter ones. I think institutional investors I talk to are kind of taking I don't think I should position for it differently now sort of view, and then we'll see if we have to worry about it. So I don't know anybody who's doing a lot of trading around it at the current moment.
Right. One thing's for sure, your healthcare trade is finally coming around. XL, the healthcare index, back to April levels now.
Yeah, it's been a bad call, but it's worked recently. My view is that healthcare is the area where we're going to see the most benefits on the productivity side from AI. I think a lot of that's 2026 and 2027. We've been highlighting drug distributors like McKesson, Cencora Cardinal, Quest, like businesses that have a lot of employees and low margins and therefore can benefit as they implement, predicting their customer and employee behavior better.
I know, the old adages don't trade on a shutdown and it'll just reverse economically. But now that there is this threat, from the White House budget director of mass firings rather than just, furloughs at a time where ADP this morning showed another month of declining job growth. We've seen signs all over the place of labor softness. Does it make you rethink at all the trajectory for the job market, which is really holding the consumer and the economy together?
Hi, Sarah. Look, not really is the short answer to your question. Meaning, I think the bull pillars are one, productivity from AI coming in 27 and beyond, as we, from all the spend, and two, the distribution of outcomes for the Fed is more dovish. So most equity guys are going to say, look, Sarah, do I want to fight the S&P tape in a holistic way if the Fed's going to get more dovish and margins are going up for the average company? No, I don't. Now, whenever you phrase it the way you did, is it all more worrisome? And yeah, it could be, but I just think right now people aren't going to sell the dream of some of the upside productivity just because there's so
the AI trumps everything. Is that basically it?
It's in the innocent until proven guilty mode still. Yeah.
And does that work for the entire market or just for the mega cap tech?
The biggest worrisome thing, we do a lot of risk management work for institutional investors at Trivariate, and the biggest worrisome thing I see is the correlation between, let's call it the alternative asset managers, even the big three, Goldman, Morgan Stanley, JP Morgan, and let's say industrials like Eaton and Caterpillar, and obviously Power, GE Vernova, Vistra, Constellation. They are all highly correlated to AI semis. So the challenge is you have these different sector bets in your book, industrials, alternative asset managers and financials, semis, and power, and yet they're all really correlated. So I think the real risk is that when that gets out of favor, a lot will roll over, and then maybe Carl, the healthcare thing will look good during that regime too. So I think you've got to find other things. We wrote at Trivariate last week, what stuff is correlated at a very low level, like 0.2 or lower to the AI semis, but is also up year to date. So I'm trying to find things that are working both fundamentally and stock-wise that aren't the exact same trade as everything else that I just listed, because that is the fear I have, that when it unwinds, it'll be sharpened across multiple sectors.
Right.
Yeah, although, Adam, typically when something unwinds like that big, everything gets hit. I mean, there's no place to hide. Is there really?
Well, yeah, I think if the market goes down 10%, it'll be hard to hide, but maybe you can be down 2 or 3 in certain areas. And I think the challenge is historically the playbook would say, buy staples. or something like that. But as you've seen, like they don't have pricing power versus the big kind of consumer companies like Walmart, Costco, and Amazon, or there's GLP-1s or other things that are impairing them. So the classic defensive playbook has been a little bit impaired too. And so I think people are struggling with, is the new defensive something that's not disrupted by AI, meaning aggregates, Vulcan or Martin Marietta, or waste management, or something that I know I kind of need in 2030, independent of what the AI, landscape looks like.
Right. Although WM is a proxy for economic activity too. It's a good point about where you would turn. Adam, we'll continue the conversation soon. Thanks, Adam Parker. Good to see you.
All right. Take care.
Here's our roadmap for you for the rest of the hour. Nike shares rallying after posting surprise sales growth. Is the turnaround for real? We'll talk to an analyst who sees a lot more upside ahead.
Plus, the IPO floodgates seem to be open. We have 2 companies that are going public today, including one that is trying to benefit from that AI boom. We also have a name in the flood insurance business.
And Apollo's Torsten Slok is going to join us at Post 9, talk about the impact of the shutdown and what he says the street got wrong about the state of the economy as Squawk on the Street comes back.
Nike popping this morning on a top and bottom line beat alongside a surprise growth in overall revenues. And guys, the story of the quarter here for Nike is that it's progress in the turnaround, but there's still work to do. I highlighted 3 areas that Nike specifically called out where it saw good growth and where Elliott Hill, the CEO who's been there for about a year, who came to turn it around, has been focused. North America, the home market, it did grow 4%. That was definitely an improvement. Wholesale, that's the relationships with the Dick's Sporting Goods and the Foot Lockers, and now they've opened new relationships with Amazon and Aritzia. That saw some nice growth. Running, that's been a category they've been really focused on, and Hill gave a lot of shout outs to the running team, growing more than 20% during the quarter. Some early signs that the new innovations there are working. They redid the Vomero and the Pegasus Premium, and those have been good sellers in the running space. That doesn't mean, though, that it's all clear when it comes to this turnaround. China, for instance, is still seeing declining sales, down 10%. And then the sportswear business, it's something that Hill highlighted on the conference call last night as room for improvement. Listen.
While the sports performance teams are finding a higher gear, our sportswear teams have work to do to get sharper on the consumers we're serving. And we see it in our results. Our business continues to decline. Continuing to build a clear product construct in sportswear, as we're doing in our performance sports, remains a priority. We do have pockets of strength, especially in our deep vault of look-of running footwear, but we are still in the process of putting our largest classic franchises into a healthier position for the Nike, Jordan, and Converse brands.
So there's a lot of that from Hill on the call last night, talking, guys, about the wins, and there definitely has been, and some progress, but then also recognition of some of the work to do when it comes to, as Hill himself said at the top of the call, restoring Nike back to greatness. He said we're early and it's happening. And then he and also the CFO in the release said it's not going to be linear, and it's still a tough operating environment. Now that $1 billion that they mentioned last quarter in tariff costs was elevated to $1.5 billion because of the new tariff rates, for instance, on India and Vietnam with some of these trade deals. So managing through that kind of environment at the same time as trying to turn around the company.
Yeah. I mean, Jim was very positive on it this morning in terms of the leadership of Mr. Hill and his focus on sports. But there are those who say, listen, it trades at a pretty high multiple to earnings and still doesn't have significant top-line growth at this point. That's just from a stock perspective, so to speak, Sarah.
Yeah, it's sort of being treated as a show-me story when it comes to the results. They guided for mid-single-digit revenue declines, and they put up 1% revenue growth. So that's definitely better than expected. But it's not. Look, they have to make it up, and they lost market share over the last few years, and that's why Hill is there and is super focused on switching the culture and the innovation. By the way, I know you were wondering about the Skims Nike launch.
Yes, very much wondering
They dropped
about
that
Skims.
collection
Yes.
last week with Kim Kardashian. The word on that from Mr. Hill is that the early customer response has been very strong.
Are all those people in Skims? Is that what's going on there?
They were on the steps in New York City. They were Nike Skims. It's a new collaboration.
Nike Skims. Got it.
I haven't tried it yet. Let's bring in an analyst who was very skeptical back in the Donahoe days. Senior equity analyst Sam Poser now has a buy rating, $100 price target on the stock. Sam, you like what you see?
I do. I mean, look, I knew this was going to be a lot of work, and I had expected to hear positive things today or last night about what was coming in the future, and we're seeing the little pieces of it. But, it takes a long time to create new product, bring it to market, and they've had little pieces of that coming in the prior quarter. But I think for holiday, we'll really start to see that, and we'll start to see the sell-through rates. And once we see the sell-through rates, I think, people will start, investors will start stepping up more. That's the show me story you just mentioned. I think the show me is going to be on the data that starts coming out. And there really hasn't been a lot to work with up to this point. And that in holidays when a lot of the large number of pairs and units of new products start to show up.
Sam, I always give you credit, during the Donahoe days when you were almost, journalistically finding out about the talent shortage and the fact that all of these, key people in design and innovation and sales had left or were in different roles. So now that Elliott's in, he changed the entire leadership team and has also restructured the business in this sport offense that they announced last quarter. What do you think about some of those changes and whether it'll yield some of the results that will ultimately make Nike cool again?
Well, I mean, I think it's multifold. I think when he came back, I think the people at Nike realized that they had a leader that understood what Nike was all about, which was lacking before. The sports offense, it's sort of what's new is old, what's old is new again. It's the category offense that they're calling the sports offense, which is, as far as I can tell, exactly the same thing. And it brings people around single sports together. I mean, they had it men's, women's, and kids, but the men's running team was in a different building than the women's running team. And now they're all together under the running team. And I think that's essential to make it work. But that's bringing it back to where it was. And to be cool again is really getting the market cleaned up, which, I believe outside of China is, probably over 90% finished. and then continuing to bring in newness in the correct amount at the correct place and generate more attention to the brand. And I think all of that, I think we saw the first steps of that in the first quarter.
Okay, Sam, we appreciate your take on it. $100 price target. Always good to talk to you. Sam Poser from Williams.
Thanks very much.
Still ahead, a big morning on the IPO front, both here and at the NASDAQ. What investors need to know about real estate investment trust Fermi and how it's involved in AI. We'll get the details on Neptune Insurance going public here at the NYSE and how the shutdown might impact that company in a minute. Getting a news alert out of Washington this morning. Let's get to Emily Wilkins with details. Morning, Emily.
Good morning, Carl. Well, yeah, as the shutdown stretches into its first day, we're getting an interesting update from the head of the Office of Management and Budget. Remember, this is the agency that warned about numerous layoffs and large-scale layoffs. And we know that the head, Russ Voigt, is going to be speaking with Republicans a little later today, and we expect him to give more details about plans. But right now, he is tweeting that the roughly $18 billion project in New York City infrastructure projects are being put on hold. This includes the Hudson Tunnel project and the 2nd Avenue subway. And look, Voigt says on Twitter that these are based on unconstitutional DEI principles. That is what he has said on Twitter. He says more is coming soon, but it's impossible to miss the context here. I mean, these are projects that are taking place in New York. This is the state that Senate Minority Leader Chuck Schumer is from. This is the state that House Minority Leader Hakeem Jeffries is from. And the Hudson Tunnel project is one that Schumer in particular has really pushed and and lobbied for. So this is an example, I think, of what we might going to be seeing during this shutdown. The longer it lasts, the more we expect to see cuts in funding, cuts to programs, federal layoffs, and it seems that this is the initial shot across the bow here just a couple hours into the shutdown. Guys?
Thank you. Yeah, obviously Chuck Schumer and Leader Jeffries as well, both New York Democrats. That Hudson River Tunnel, boy, it's had a long life from being in place, and then Chris Christie, when he was governor, cut the funding off, then back on. All right, let's, speaking of funding, let's move on to the IPO market this morning. You're welcome, Emily. Fermi is a name we're keeping an eye on, and we're going to get to the other big IPO of the morning as well in a moment with Contessa. But taking a look at Fermi, hasn't opened yet. $21 a share. They sold 32,500 shares of common. It's a REIT. It's a REIT with big plans for the future in terms of kind of pitching itself as a powered land REIT that they say is positioned to solve the AI power crunch by controlling both the land, over 5,000 acres in Texas, that they have a 99-year lease on, and what would be dedicated multi-gigawatt energy supplies. It's going to require a on that one. By the way, I should point out you immediately are diluted or lose $18.72 a share in terms of new investors, in terms of the dilution, so to speak, that takes place. Fermi, not the only name, though, going public today, right, Sarah?
Yeah, right. We got another one, Neptune, parent company of the biggest flood insurance provider here in the U.S., making its debut at the New York Stock Exchange. Contessa Brewer is here with the details. Can't remember the last time we had an insurance IPO.
I mean, this is really exciting one because it's the biggest private insurer, but also Neptune's IPO happens on the first day of the government shutdown. This might be the most opportune timing ever. After all, its biggest competitor is the National Flood Insurance Program, which covers 67% of the nation's flood insurance policies. But of course, it's closed today. Not processing applications, not processing new claims because of the government shutdown. But Neptune Flood?
Neptune is open for business today. We can help the 1,300 people every day who are trying to close on their homes, who need flood insurance or required to have flood insurance. Neptune can help those customers make sure that those homes closings can continue. For a long time, the only way to buy flood insurance was through the federal government, through the NFIP. That's not true anymore, and Neptune is here to help.
Flooding costs the nation roughly $200 million to $500 million every year, according to the Joint Economic Committee, and only about 4% of properties carry flood insurance. So what's the investment thesis here?
It's a new breed of company that's using technology to be incredibly efficient, and the outcomes speak for themselves. Our underwriting results are miles different from the federal government's. This is a peril. This flood insurance product. We're able to make sure the customer wins, the agent wins, Neptune does well, and importantly, the global insurers don't lose their shirt on investing in flood insurance.
They're using advanced technology, including AI, to look at individual properties, not zip codes, not whole neighborhoods, but property by property. And he says, look, if we come to you and we tell you that you're going to pay $200 a year for flood insurance, it means you're low risk, you're good to go. If we give you a price that you think is too expensive, it means that you're a high risk, and it accurately reflects the risk. And he goes, and if we won't cover you, you should move. Pretty strong words from the CEO of Neptune.
Yeah, I was going to ask you about the AI story here, because I guess that's important when you're going public these days. And I remember going to AIG's Investor Day last year, and AI they had the CEO of Anthropic and Palantir, and it really is changing the entire insurance business.
At every step of the process, the claims processing, how you incorporate information about wildfire risk, AI is now looking at that, and it is changing the process. So what you will see happen is, Chubb years ago was trying to lower its exposure to California wildfire, and they did that because they knew they could not get a return on the investment there, and what drives the regulators crazy. When you have insurers that are using advanced technology now to look at their risk and to say, we can't get enough rate to cover what the risk is, it means that the regulators, the state, building codes, all of that has got to come into play. And so it's going to change not only insurance, but it may change the way we see building in the nation going forward.
Even the Fed chairs talked about insurance deserts where you just can't get it. Pretty fascinating. We'll watch today. Thanks, Contessa Brewer.
And apparently I was wrong. There have been a bunch of specialty insurers, IPOs, this year. Just not big
It's
ones,
so amazing to have producers in your ear going, actually, Sarah.
No. I just looked it up because I wanted to make sure I was
good.
right.
It wasn't even the producers. It was Sarah.
A few of them this year.
Let's get a news update with Silvana Hanam. Hey, Silvana.
Carl, good morning. European Union leaders are meeting today in Copenhagen. They are facing mounting pressure to boost security following a series of Russian incursions in EU airspace, including in Denmark and Poland. The Danish Prime Minister said this morning that the EU is in a hybrid war with Russia and the continent must arm itself. A disappointing outcome for tourists visiting Munich for Oktoberfest. German police closed the fairgrounds today following a bomb threat that was linked to an explosion in northern Munich that killed one person. Police are searching the Oktoberfest grounds for explosive devices and say it will be closed until at least 5 p.m. local time. And part of a high-rise apartment building in New York City collapsed this morning. First responders say there are no immediate reports of injuries. The fire department says it was responding to a possible gas explosion that caused the incinerator shaft in the 20-story building to collapse, Sarah.
Okay, Silvana, thanks. After the break, Apollo's chief economist, Torsten Slok, with his take on the one aspect of the shutdown that could really matter for this economy. We'll be right back.
ADP coming in weak this morning as the government shutdown gets underway, putting in jeopardy the release of future data. So when it comes to employment, that may be the number we get this week, at least, down 32,000. Let's get over to Apollo Global Management Chief Economist Torsten Slok, who joins us here at Post 9. Torsten, you write recently the U.S. economy remains remarkably resilient. Does the ADP number change at all? Any of your view on that?
Well, what really is important is that the labor market is obviously showing signs of weakness, but everything else is actually looking pretty good. If you look at including Nike earnings overnight, if you look at the weekly data for retail sales, if you look at how many people travel in airplanes, if you look at GDP for Q2, the Atlanta Fed GDP for Q3, 3.8, 3.9. I mean, there is something going on with the labor market. What is that? That is likely that immigration is slowing down. So this is why the labor market slowdown is likely not a reflection of weaker demand, but it's likely a reflection of weaker supply. And that is very important because that inconsistency is now becoming more and more clear in the labor market, really relative to most other things on the economic front.
Speaking of consistency, you've been rather consistent in saying that the chances for inflation perking up are fairly high. And you've been saying that for some time. You've certainly been a guest, I believe, and am I right, Sarah, that has argued that rates should not necessarily be going down. Do you still believe that?
Absolutely. The title of my piece today was that we in the economics profession, we need to look ourselves in the mirror, because what has been going on is that we're now 6 months away from Liberation Day. And we still have arguments that, oh, we're still just waiting for the delayed effects of what was happening with the trade war. We had so much uncertainty. All indicators of trade war uncertainty have been coming down. Indicators of economic policy uncertainty have been coming down. And on the back of that, in the meantime, you still have had GDP growth that was really strong in Q2. And again, the Atlanta Fed now saying we'll have GDP growth of almost 4% in Q3. This labor market is really standing out as a very unusual set of indicators relative to everything else that's
So are
going
you
on.
saying that you were wrong expecting inflation?
Well, I think that the case for inflation is just even stronger now, because there was already inflation coming because of tariffs. There was inflation coming because of the dollar going down. And now we have an economy that is just remarkably resilient. There are still some corners of the economy that's impacted by tariffs, yes, but these things have just not been big enough to slow things down in the aggregate. So that's why in the micro data there's some issues, but in the macro data things are still doing exceptionally well.
So you're worried about inflation not coming from tariffs, coming from a strong economy.
Both tariffs and a strong economy and a weaker dollar. And also, if you do deportations at the current pace, you also see wage growth go up in the sectors where unauthorized immigrants are working, namely construction, agriculture, hotels and restaurants. So the list of bullet points for why inflation is going to be higher is just growing even further if the economy actually ends up not slowing down as much as we thought just a few months ago.
If all that's true, why is the hiring rate where it is? CapEx intentions, UMISH, right? I mean, how are all those things coexisting?
So the regional Fed surveys, CapEx intentions are actually beginning to move higher. It really is correct that the labor market is at a standstill. You have very little hiring, very little firing. That is, of course, also reflecting that, well, if there is not much immigration coming in, well, then, of course, you will not have much hiring. By definition, under Biden, whoever we all voted for here is a side issue. But in the last several years, we had job creation of around 200,000 every month. Now we calculate that that's more like 50,000 every month. By definition, that means that job growth should be slower. So that's why the ADP data, of course, negative numbers, as David is saying, that's not great. But a very, very important backdrop here is to think about why is it negative? Why is it slowing? And it is absolutely slowing because immigration has slowed down.
So as an employer, my hiring decisions are based on immigration flows?
Well, if you can't find workers, if you can't find people standing outside your door, then you, of course, will have, well, then I'm not hiring many because I can't find the workers that I'm looking for. So that's why a lot of anecdotes continue to now confirm that there are challenges with finding workers, especially in the sectors where unauthorized immigrants are working. So I do think that we need to take that analysis now into saying what's going on in the labor market, what's going on elsewhere, and elsewhere just continues to be remarkably resilient.
I wonder how important is the growth of data centers and the building of them to the overall growth of the economy? And I mention that in part because I know you've been doing work. I think you recently came on and talked about perhaps the lack of a return on invested capital, at least at this point, in terms of what we're seeing in the enterprise for AI usage. But when it comes to data centers, Torsten, is that a big part of what's going on right now?
That has been contributing more to GDP growth. So that has absolutely been lifting GDP in the last 2 quarters. So this is indeed very important. Of course, there is a very important debate around, is this justified? Can the companies generate the earnings everywhere in that complex? But the bottom line is this, from a GDP perspective, has indeed been a very important factor.
You expect it to continue?
Well, the issue now becomes whether valuations can continue. So, as you know, Tesla with a PE ratio of 150 to 200, is that at the right valuation. Likewise, Nvidia, Apple, Amazon, of course, PE ratios at these levels that we're seeing, of course, require significant growth in earnings over the next several years. And given these companies are now so big, everyone expects earnings for the AI complex to begin to slow down. So it does, I know it's very circular, this discussion, but it does begin to imply that if companies can deliver on that, then everything is great. But if there's any sign of a slowdown, like you're seeing in the bi-weekly census survey of AI adoption beginning to weaken, in particular for larger companies, then you could begin to worry about the broader ramification if there is some question marks around the overall AI theme.
Yeah, well, especially given the trillions that are going to be spent, and the debt markets, obviously Apollo playing an important role in that as well. Torsten, thank you.
Thank you.
Torsten Slog.
Pfizer and Merck on pace for their best two-day performance in a couple of years. We'll talk about if a real healthcare comeback is in the cards here. We are moments away from an interview you don't want to miss. Billionaire investor, Omega Family Office CEO Lee Cooperman's with us. Stay with us.
We are over 30 minutes here into the hour. Here are three deal movers we're watching. Berkshire Hathaway reportedly in talks to buy Occidental Petroleum's petrochemical business for around $10 billion in what would be Berkshire's largest deal since 2022. Occidental up 0.5%. Meantime, shares of Lithium America surging as Energy Secretary Chris Wright confirms that the government will take a 5% equity stake in the name and a 5% stake in its lithium mine project that's being developed in Nevada. Also, utility group AES at the top of the S&P right now on a report that BlackRock's Global Infrastructure Partners is nearing a $38 billion deal to buy the power plant operator in what would be one of the largest infrastructure takeovers of all time. This is one that's been hit on the removal of the clean energy subsidies, Carl, but has also been a supplier of renewable energy for power for some of these hyperscalers.
Meantime, the president, as you know, announcing that pricing deal with Pfizer yesterday. Why one analyst says it could give the whole sector a boost after the best day for XLV against the overall market in months. Meantime, the CEO of Peloton, the fitness company, announcing some new hardware and AI-powered coaching. When we're back in a moment.
President Trump announcing Trump RX, a government-run website where customers can go on, purchase pharmaceuticals directly from the manufacturers. Pfizer announced availability of various prescription drugs on the site for reduced cost. A number of pharma stocks moving higher on the news. Jared Holtz, Mizuho Securities USA healthcare sector strategist, joins us now. Jared, help us understand, if Pfizer is going to sell drugs cheaper, why does the stock rally?
Well, I think this whole rally is basically the street looking at the sector and seeing an underperforming group of stocks that potentially will be more removed from the angst associated with this administration from a policy standpoint. I mean, this has been by far the biggest overhang on this group for more than a year. And if Trump and this administration kind of move away from drug pricing as such a predominant topic or theme, then this is a positive.
But isn't this putting in place the most favored nation status, where the drug makers have to give basically prices at the lowest rate that they're giving around the world? Isn't that very bad for profits?
Well, I think it depends on the company. I think when you're looking at Pfizer, some of the multinationals that are very big and diversified, if they're looking at a small group of drugs that are pegged to the most favored nation, especially with Medicaid as being the biggest channel, it's probably resolvable. There are ways that you can probably still make earnings, and so the risk factor dissipates a bit. I think investors are looking at this maybe a little bit more negative for companies that are more Medicaid heavy versus a Pfizer versus a Bristol. And obviously the multiples of this group have really never been lower. So I think that's why you're seeing this relief rally.
Dr. Oz was asked how soon you could see prices really get reflected. He said certainly early next year. Does that make sense?
Yeah, I think that timing is right. I think we all kind of looked at this as a 2026 event. You also have to tack on the IRA, so drug pricing is coming down for other products. We have the LOEs to worry about, the loss of exclusivity, so the patent issue doesn't dissipate. So to me, this is a near-term trading dynamic. Obviously, it could go on for a little bit longer. You have stocks trading at 6, 7, 8 times earnings, clearly a mile away from where the market is, and the performance has been pretty awful. So I think near-term, this sector trades pretty well, but then we have to go back and look at fundamentally where all these companies stand.
All right, well, we'll keep it quick today. Just good to get your take on all of this. Jared, thank you very much. Good to see you. Jared Holtz.
Getting some breaking news on the case regarding Fed Governor Cook. Let's get to Eamon Javers. Hey, Eamon.
Carl, that's right. The Supreme Court is saying it's going to have arguments in January of 2026 on this case involving Lisa Cook and the Federal Reserve. Remember, the president's been trying to push her out with allegations of mortgage fraud. A lower court had ruled that she could stay on the Federal Reserve Board while the case was pending. The Trump administration filed asking for a stay of that decision. They wanted to fire her immediately. And in this new order just released within the past couple of moments, they're saying the application for a stay presented to the Chief Justice and by him referred to the court is deferred pending oral argument in January of 2026. So that means that Lisa Cook will be able to stay on the Federal Reserve Board through those arguments in January of 2026 and then pending the outcome of this case ultimately. So a defeat here for the Trump administration, a win for Lisa Cook's legal team. But it does not mean that she is necessarily out of the woods here in terms of this argument. But it does mean that we should see the Supreme Court take this up in January, guys. Back over to you.
So what happens between now and January? Do we know? Is this punted to another court to look into these allegations, or it's still in the hands of the Justice Department?
There is no other court other than the Supreme Court, right? That's as far as you can appeal. So it's going to be up to the Supreme Court to adjudicate what happens here. But that won't happen until these oral arguments, which they're saying in this order just released, will happen in January of 26. So between now and then, it's status quo, right?
Not on whether he's allowed to fire her.
Right. I mean, presumably on the fraud allegations, the Trump administration is going to continue to dig to look for evidence to back up their case that she committed fraud, and her legal team will continue to dig to find evidence that she didn't commit fraud. So that discovery, that investigation will be ongoing, and you might get leaks out of that process during the months to come that will be embarrassing for one side or the other. But ultimately, this is going to be up to the Supreme Court. That's the highest court in the land, and they're not going to take it up until January.
Yeah. All right. So between now and then, Lisa Cook stays on the Fed. Let's bring in Steve Leistman, find out what the implications of that are. Steve, she's not going anywhere.
She's not going anywhere, and it's deferred, David, until January, when, of course, the Fed itself will undergo a bunch of changes. You'll have new presidents come in to govern, and also you'll have that Stephen Myron Fed governorship come up again. So there'll be additional changes, but at least it seems through the October and the December meetings, which are the two remaining ones for the year, there'll be stability, and we won't be reporting ahead of the meeting that we're not sure how many people will be voting as we did for the September meeting. So there'll be some stability on the board through then, and then they'll undergo some changes. What's interesting then, by the way, is in February, I believe, it could be March, the Federal Reserve Board will vote to reappoint the presidents. And this is where it's key. If the president and the administration, David, want to make that change on the Federal Reserve, among the Federal Reserve presidents, they need a majority of the Federal Reserve Board. Unclear at this point. I'm reading this very short order, but the stay is deferred pending established briefing schedule for amicus curiae and somebody moving, pending oral arguments. So maybe it can be decided in January, but maybe perhaps after that.
Right, Steve. Yeah, I mean, it can sometimes, you can have a significant interregnum between when the case is argued and when you hear from the Supreme Court.
Right.
But sometimes they can do it in a much more a quicker fashion as well. Steve, while we got you here, just in terms of, reaction to the ADP number this morning and the likes, and what we can expect given where the Fed is right now, and obviously given that Lisa Cook will remain one of the members.
Yeah, I mean, the problem with ADP is always that it's not very good on a month-to-month basis, but when you take a step back and you use 3-month averages compared to the BLS, along with the BLS revisions, and then even 1-year averages, it's a much better indicator. It's why I'm not very concerned about not having Friday's jobs numbers or even another month, but over time you lose contact. Now, ADP, of course, re-benchmarked its numbers this year, so that caused a downward revision. But according to ADP, we're in negative territory when it comes to the jobs report. And you saw what happened to the bond market, a big rally there, as well as in the Fed funds, where now there's a lot more confidence in an October cut and a December cut as well. And they're working on a third cut in January or March as well. So all of this is telling the market that the Fed is going to be more concerned about jobs, or increasingly concerned about jobs, relative to the concern about inflation than it has been.
Yeah, and of course, when it comes to jobs, we are at this point certainly not likely to get the jobs number on Friday, given the current shutdown. Steve, thank you. Steve Leisman, of course, reporting along with Eamon Javers on that decision that we're now going to be waiting for from the Supreme Court in terms of the future for Lisa Cook on the Fed. That does it for Squawk on the Street. Money Movers starts right now.